Welcome, everybody. Hello. Hello, hello, hello. Let's get something on my screen, shall we? That will do. Hit me up in the live Twitch chat room, or preferably in the Twitch chat itself. Just let me know hi. How are you? How's everybody? How's your training week been? Personally, I have been doing a whole lot of not much. This week has been... since last week we knew it was going to go down, and today was kind of just proving that right. So here we are. Commodities are looking rather painful. Hello, Vienna Alec. And welcome to the stream. The one unfortunate thing is it doesn't quite update my viewers anymore. It used to tell me exactly how many viewers I got, but now it's not. So I'm just gonna assume that I'm talking to people, and otherwise I'll be talking to a wall for the coming 30 minutes, and that's okay, I guess. So what we're looking at the last 2 weeks. So I haven't been able to stream last week. That was due to work, just being extremely busy. I don't have a ton of time tonight, but I want to make some time. And there we go. People are streaming in. Welcome, welcome. I wanted to talk about real yields. We kind of in the chat touched on when we started seeing the warning signals, real yields tapping 1.4. At that point, kind of everyone that I talk to regularly, Arendon, they started seeing the same signs that I was, which is what real yields signal. And it could signal a couple things. I think the Fed and mainstream news are kind of behind on what that might mean. And I'm not sure if they just selectively forgot or if they are presenting an ideal scenario because they don't want it to sound too doomish. But real yields signal the following. So they could be a prelude to growth. That is something, if you open up a random economics textbook from the 90s, from 2000s, they will tell you that real yields going up signals growth. And that is indeed one of the classic signals of real yields going up. Now, growth goes paired with a couple other things. So if there's growth, that also means there's inflation. And if there's inflation, oftentimes it also means there's growth. Right? But for now, what we heard is we heard a lot of people talk about growth, about the fact that real yields going up isn't that big of an issue. They haven't really touched much on the price of the bonds, bond interest going up, bond prices going down, 10 years, looking at now 1.6 almost and rising. What to me this primarily signaled is inflation, not growth. I don't think the economy is seeing too much growth. You know, if you say, okay, there's growth because real yields are going up, I ask you, what growth? Where is this growth coming from? There's a lot of finance, a lot of money flowing into the economy, but I don't see a restarted economy. I don't see a boost in land or labor or technology. So if there's no boost in land, labor, or technology, the only thing that's boosting is capital, and that was already the case last year, and it's simply more the case today. But those see diminishing returns. I don't agree that the increasing of real yields is based on growth. So if not growth, what is it? And that leaves one answer, and that's inflation. So what I think is going to happen, and what I said last week, and what so far has been happening, is I think that the real yields going up is the bursting of the bond bubble. We have a bond bubble going on right now. With bonds that are overbought, junk bonds that are overbought. I think every bond right now is a junk bond. We're seeing those bond bubbles bursting, which will be followed by the equity market bursting. And when the equity market bursts, and I'm talking about taking off the froth in tech, I'm talking about moving out of alleged growth stocks with no profits or pre-profit or pre-revenue companies. I don't believe that in pre-revenue companies, or especially not ones that have been pre-revenue for 10 years and say, well, in 15 years maybe we'll think about maybe making a profit, maybe, potentially, possibly. Don't be mistaken, the people working there are making a profit. They make salaries. CEOs are getting beautiful bonuses, but actual money is not being made. That's simply capital injected by investors and by central banks that lead to these inefficient companies taking up resources. So that leaves the equity market to start bursting. And I don't think I'm not really an apocalypse thinker. I don't think it's going to lead to crazy high inflation. I don't think we're going to see hyperinflation or stagflation. We could, but I don't think that's very likely. I think for now, what we're going to see is the following. The Fed are going to be forced to act sooner rather than later. The bonds going down, equity going down is a formula that historically and I think in the future, there's nothing else that will force the Fed to act faster than bonds being down and equity being down. So the Fed will most likely act. And when the Fed acts, they have one option, and is yield curve controls and raising interest rates. And they keep saying, the thing about the Fed is, if the Fed says we're about to head into a financial crisis, if the Fed says we're looking at a potential currency crisis, what's going to happen is exactly what they say is going to happen, and it's going to cause a crisis in the first place. So they can't afford to announce an upcoming crisis, because them announcing it will be the catalyst to bring it forward. So they can't afford to announce a crisis, which leaves them to say that everything is hunky-dory, and they claim to have the tools to combat it. But looking historically, the Fed never had the tools and never had the understanding to deal with inflation, not in an efficient manner. It was either destroying the economy or trying to combat inflation, and often they do both. In an effort to not completely kill the economy. But the U.S. economy is already very fragile. We're looking at a U.S. economy where more than 50% of the households are looking at refinancing. More than 50% of Americans are behind on their rent. They can't afford interest rates to be raised. If they do that, these people are going to go broke. Where debt is beyond GDP, and these interest rates, they cannot afford to bump them up. So I kind of make the comparison to a bone saw. Yeah, the Fed has a bone saw. It can raise interest rates. It has that bone saw. But just because you have a bone saw doesn't mean you should be all that eager to, saw off a gangrene leg. That is not going to be a fun experience, no matter how, how good you are with a bone saw. And I would argue the Fed is not very good with their bone saw. So would you go to an amateur doctor with your gangrene leg and you... go ahead with your bone saw? And I think that's an excellent example of being treated by a doctor with a bone saw without anesthesia, that doesn't know what the fuck he's doing. So real yields going up means stock market going down, and we're going to see a longer depression until, I personally think, at least next week, possibly more than likely for a couple weeks. Hey, Buckwell, thank you for following, man. Welcome to the stream. I think we're going to see at least a few weeks, up until halfway March, maybe in early April, we're going to see a retracement in the stock market. And yeah, I agree, J-Powell is an amateur. He doesn't have the background that knows how to manage multi-million-dollar portfolios. So he doesn't know how big money thinks. He doesn't know how big money moves. He doesn't know how people cover their risk. And that means that the movements that he's making is not accounting for the way money flows. All J-Pound knows how to do is to press the print button, and it's worked for him in the recent past. And the thing that people are refusing to acknowledge is that this is not new. This is not a new tool that he magically discovered or that he's using with some sort of elegance. This is something that has been in the world many times. We've seen it in Zimbabwe. We've seen it in the Weimar Republic. We've seen it in Russia. We've seen it in Rome. right? Devaluation of currency, the printing of money is not a Venezuela. Yeah, it's another great example. Devaluation of currency and the printing of money is not a new strategy. It's not something that has been applied with grace anywhere else, or led to a decent outcome anywhere. If you read any historical account of what happened with when they printed money, at first everything was honky dory. Jobs went up, the stock market went up. Short term, the effects were tremendous. Long term, it led to disastrous inflation that crippled the economy for years to come, and that damaged the trust in the republic. What do you think the foreign holders of American debt will do, China and Japan? I think that China and Japan are more than happy and have been reducing their exposure to the dollar and will continue to do so. I don't think the dollar will instantly lose their hegemony. I don't, or hegemony. I don't think so. I think China will challenge the U.S. hegemony. Through military, but also through technological, through economic and diplomatic routes. And that means the dollar will see pressure and the yuan will start fighting it. Doesn't mean that we'll see China completely divesting from the dollar, nor Japan. Nor do I think we're going to see the dollar completely disappear. I think the dollar is going to play a more balanced role in the world because of what we're seeing, and I'm going to hazard a guess to say that there is going to be a significant push from the world to move away from the dollar standard and towards a more universal standard. And if I'd have to guess, that it has to have some digital component. I don't think it's Bitcoin, but I do think there might be some digital component to it. I personally think it will be a digital component backed by a physical commodity. Doesn't mean a gold standard per se, but perhaps, or some other standard that requires a certain amount of trust to be able to be put behind these digital systems, allowing these systems to operate individually without actually giving them unlimited power to print or to go beyond the reach of the citizens. Soybeans coin. Is there precedent for the world reserve currency being subject to this style of inflation? Yeah, of course. Several precedents. The most notable would be the reserve currency of the Romans. Their currency was the most used in the entire world for a very long time during the height of the Roman Empire, and that very quickly saw hyperinflation when they switched from the silver standard to a lead standard to a full lead standard. So yeah, we're definitely, there's precedent for that all throughout history. And no, we haven't seen a dollar-like situation yet, but the petrodollar is young, and it's about time for any hegemony to get challenged. If you look at historical tendency. So I don't think this will be any different, and doesn't mean we won't see another 150 years of the U.S. being in charge politically. Their military remains extremely strong, and I don't think that will change anytime soon. So I'm not preaching for doomsday here, and if I were, I wouldn't be telling you to buy. I'm not telling you to buy anything, actually. I'm not your financial advisor, and just as a disclaimer, as I often do, everything I say here is for informational and entertainment purposes only. So I hope you're both informed and entertained, but definitely don't act on what I say unless you do your own research first. With that said, when I talk about a hedge against currency crisis, I talk about gold and silver. I talk about commodities and a commodity super cycle. I wouldn't be doing that if I thought that there was a doom scenario at our feet. I wouldn't be doing that if I thought that we're going to see apocalypse, because if I did, I would be recommending you to buy farmland and guns. Which a lot of people are doing, by the way. We're seeing a huge gun shortage all across the world, but that's a side note. I think Americans has a big hubris when it comes to being number one. Yeah, and I think that a lot of Americans are blind towards the amount of power that's accumulating abroad, and they're not realizing how much influence and power those foreign powers have and how much damage they can do. Even if we're not going to see an immediate breakdown of the American power base, what we will see is a breakdown in globalism and the American system of allies and forced alliances. The big brother relationship that America has with a lot of countries that we're going to see that start to erode as there's other players in the field that can offer a similar, more beneficial deal to these smaller, younger brothers, these smaller countries that are now considered American allies. We'll have to make a choice, I think, sooner rather than later, through pressure and sometimes more honey than vinegar. I think these allies will start to erode as well, and that trade base is what mainly drives American wealth, and that means that American wealth will take a huge hit. I think across the world we're going to see 20 to 40% just less comfort, less wealth. That's just due to the breakdown of globalism. Cold War 2.0, I don't know. We'll see. We're obviously the nuclear element is luckily somewhat off the table, but we're going to see very big powers vying for global control, and that's interesting if you if you could look at it from historical glasses, but not as fun if you're right in the middle of it. Yeah, I think the next war is already on, and it's a trade war, and it started during Bush, the Bush administration, and has yet to stop. I think the financial crisis hasn't stopped either. It's just a can that's been kicked down the road and it's been hidden and swept under the rug. But all of the results that are cascading from that are still visible today, and that we're seeing that primarily in tech these days. Tech is a multiplier on resources that a country has, that an economy has, and we're seeing those factors that it multiplies. They're stronger in the East than they are in the West right now. So if that multiplier shifts from the West to the East, we're going to see a tremendous amount of economic pressure from those countries that I don't think the West will be able to hold back for very long. Exactly. Output per worker, output per square meter of land, output per dollar invested. That output is multiplied tremendously by technology. And I think one of the ways out of this shitstorm is for some new technology to come along that brings about a big boost. And, I'm talking technology to the tune of the steam engine that just changed everything, trains that changed everything. That's the kind of level of technology added, I think, that we need to dig us out of this. And I don't see any of that on the horizon. I haven't heard of any of that. I don't think battery tech is it. So we'll see. What do I think about breaking up big banks and big tech? I'm not particularly against big tech. One thing, I had a discussion with my brother about this. He's very concerned about his privacy, and that's fair. What I see my relationship with Facebook as is a mutually beneficial relationship. I'm not a user of Facebook, as a side note, so this is just an example. If I were a user of Facebook, that means that I get to use their services for free, and in return they get to advertise to me, and they get to targeted advertise to me. And that's mutually beneficial because what they're doing is they're recommending products to me that I might want to buy. And it's up to me to show the discipline to buy that when I want to buy it rather than when they want me to buy it. So I don't have a big problem with big tech. The worst big tech can do to me is sell me things I might want. That's just capitalism, and I'm a fan of that, so I'm fine with that. I think big tech is not scary or dangerous at all. As long as it remains in that purview, of course. There's examples of corporate action in history and in other places that go far beyond the scope of that mutually beneficial capitalistic relationship. But for now, we're not seeing that with tech at all. So I'm A-okay with my current relationship with big tech, and I don't think they need to be broken up. And as for big banks, I think banks have enjoyed a privileged position for the past 100 years, and they have been doing so on the back of exploiting mechanics that they should not have exploited, that have led to the breakdown of sound money, and that have led to the breakdown of trust between the users of banks and banks. We're still reliant on banks despite the fact we can't really trust them. Banks are in no position to make money right now. Their primary way to make money is broken down. And what we're seeing is banks needing bailouts and that money being taken from taxpayers. That's an abusive relationship that I don't endorse. I think banks should have been able to go under and people should have been able to lose their savings, and the government should have been there to try and help the people that might have lost their savings, but not the banks that those savings were in. And there would have been more losses in that case. But what it also would have led to is for a more systematic rethinking of what banks can and cannot do, and an increase in power of the population versus an increase in power of the banks. So I am against big banks. I am against the abusive relationships that banks enjoy over the population. That's protected by the government, and I'm in no way a fan of that. So I think that needs to be broken up in some way, be that through smaller banks, but more importantly through sound money, requirements to hold reserves up to a certain percentage of the money that you have in the bank. And of course, I understand the need for lending, and I'm also in no way opposed to lending or positioning your money in equity or positioning your money in any way as a bank. If the bank wants to put their money in a certain place, as long as that's communicated fairly to their customers, then it's up to the customer to decide if they're okay with that. If the Bank of America wants to put all their money in Bitcoin, if everyone is okay with that, then they should be able to. And if the people are not okay with that, they'll take their money out of the Bank of America and they'll go somewhere else that puts their money wherever they think the money should go. In the financial crisis, we did raise the requirements, but the problem is we raised the requirements to 35% precious metals and 50% cash reserves. The problem with that is the cash reserves is a number, a float that isn't physically held. That's just a number in a computer that the Federal Reserve controls. And this is when we talk about money printing, this is the number that's been going up. It is held in the Fed, yeah, which is where the problem lies. The Fed cranks up this imaginary number that's backing up a bank, and the bank can use that to extend lines of credit that aren't healthy because it's printed money. It's money that came out of nowhere. It's not backed by anything physical. It's nothing. It's fiat. And as long as there's trust in the dollar, that works. But as soon as that trust erodes, which I think has been happening for the past 20 years, which is exactly what happens when you print so much money, that is not a sustainable system. So that's going to work until it doesn't, and when it doesn't, it's going to lead to disaster. Fred discontinued their excessive reserve chart in October. Yeah. I heard that they changed the timelines on those from daily to monthly. I haven't quite looked into that yet, but that is part of what has me concerned. And analytics aside, just looking at the macroeconomics of things, I know what they're doing. If you look into economics for a couple hours, you can tell. And I always say, if you want to understand economy, understanding economy is good. Understanding history is better. And looking at historically what happens in these similar scenarios, we know what happens. We've seen it before. We know exactly what happens, and none of it's pretty. So that's what's concerning me about central bank policy, about where money goes, and that's also my opinion on big banks. So to answer that previous question, why is silver getting beat up so badly right now when we're in a perceived inflationary period? I think we're in an inflationary period. I think that a lot of people and banks and institutionals think that this is a signal that we're moving into rising growth and into moderate to low inflation, that they're essentially believing what the Fed's saying, which, by the way, is also what people did in 2001 and 1999 and in 1987 and in 1967. They believed what the Fed said until there's so much irrefutable evidence that you cannot believe what the Fed says, and then a crisis hits. So the Fed has lied to the population before. It's led to financial crisis before. People have believed them before, and now we're doing the exact same thing. I'm not buying it. I'm buying commodities because of that, and I think the moment that things reverse, we're going to see an obscene amount of money flow into commodities because it's one of the only safe places to hide. I know Bill Clinton wasn't the best, but at least we had a surplus. I mean, the problem with Bill Clinton at the time is he also read a deficit finance strategy, and he also expanded the balance sheet, and he also expanded on trade with China and moving physical labor from the U.S. to China, which on the short term saw a lot of benefits. But now we're really getting into the nitty gritty of trade, which is interesting for another episode. But we'd have to. First of all, I want to get some numbers ready before I do that, and second, I think it deserves its own episode. So yeah, that is my view on the macroeconomics of things. Now, short term, that means I took a more defensive portfolio. I am primarily positioned in stocks that are not going to go down, that will get back up to where they are because they're making money left, right, and center. Yeah, I'm talking Barrick Gold, I'm talking semiconductors, I'm talking Apple, companies with ironclad balance sheets, low debt, high cash flow. These companies will do fine in a period like this because they're making money. So even if a really rough period hits, I think these companies will be okay. And then next to that, I have my portfolio that's in precious metals, and that portfolio, and in commodities. That portfolio enjoys the double whammy of both the commodity supercycle and the inflation crisis that I think, or the inflationary crisis or the currency crisis that I think is coming. So that's my hedge. It's not more than 50%. It's closer to 30%. And the rest of my portfolio dances with the bulls. If we get back into a bull market, I'll enjoy that. If we don't, I'll be okay. So that's my strategy, and I think for the long term, it's one of the safer places to be. And and that's the recap for the past few weeks. The only thing we haven't really touched on yet is meme stocks. We haven't really touched on what's happening with GameStop, what's happening with AMC. So what's interesting to me is Roaring Kitty has not taken his money out of GameStop, allegedly. We don't really have, he doesn't, submit 10Ks, he doesn't submit his positions, he doesn't have a big enough portfolio to have to do that. He could have sold half already, we don't know. He's waiting for one final push after his hearing, and then selling a bunch wouldn't have been illegal and would have probably been smart. From what I heard from institutionals down the grapevine is that they're waiting for, they're happy for retailer money to move into these stocks because they're literally just stealing candy from the baby, because they have faster systems, they have faster algorithms, they have better financial positions, they have larger orders, meaning they get higher priorities. So they are more than geared up to fight this battle. And I think retail is in for a nasty surprise yet again. So I would not recommend meme stocks, and I hadn't recommended meme stocks for a while. And I don't think there's going to be a short squeeze. And we're seeing nice upward moves. I think that's in large because of institutional money and not because of retail. Anything else to suggest otherwise, I think, is a trap. So be careful with your money. If you can ride the wave, fantastic, good job. Make sure you get out when you get some profits, or set a very strict stop loss. And if you're thinking about buying right now, think about this. If you're happy to buy it, if you were happy to buy it, if you felt that FOMO at $140, you must love it right now at $100, right? You think about that for 10 seconds, you're like, oh, wait a minute, I'm FOMOing. So yeah, if you love it at 140, why didn't you love it at 50? Why didn't you love it at 70? So before I end the stream, and I want to thank everyone for watching. I see we have almost 10 viewers again. You guys are awesome. Hit follow if you can, and especially getting all of this amount of viewers without the tag working is an honor. So I really appreciate everyone being here. You guys are amazing. And it's really fun to do these streams, and I'll try to keep doing them every Friday. So yes, hearts. Is there any final questions before we? I need to get an ending segment, a little anime closing ending. If anyone's good at animating, make me a cool animation for the ending of my stream. All right. Well, thank you all for watching. We'll be in touch. I'll be on the Discord as usual. Fiverr. Okay, let's take a look at Fiverr before we go. No, wait, too late. We're looking now. As in, like, animation? Oh, ordering an animation from Fiverr. Yeah, because this doesn't look. Well, actually, it's up, so that's cool, I guess. Yeah, maybe order a Fiverr animation. We'll see. If I get like 10 subscribers, I'll probably do that. Anyway, thank you all for watching. And I'll see you guys next week.